Great, so welcome everyone. Delighted to be here and discuss the fundraising options and give you a bit of an insight as to the funding landscape. We're going to discuss a little bit on valuation implications and also give you some tips on engaging with investors. My name is Jonathan Hollis. I'm one of the partners and co-founders at Mountside Ventures. We've launched quite recently. Before that, I used to run PwC's RAISE programs, which helps early stage companies raise institutional finance. And before that, co-founded PwC's Corporate Accelerator, which has worked with about 400 companies, many B2B companies, many SaaS companies, and have now got a combined valuation of over 2 billion. And I started my career at the firm with an audit and spent a bit of time getting my accounting qualification before moving on to deals. And prior to that, I had my own startup whilst at university. That's me. John?
Hi everyone, thanks for joining us today. I'm also one of the co-founders of Mountside Ventures, and essentially within the organisation I'm responsible for supporting startups, sourcing startups across Europe and helping them prepare for their fundraise. Before Mountside, I was at PwC, and I guess my background is mainly helping companies with their late seed and Series A rounds. And before that, I was in the much more boring industry of mid-market private equity and valuations. Cool. So what do we do at Mountside? So our overall objective is to help entrepreneurs raise their next round of funding with minimal disruption to their business and decreasing the funding timelines and getting the best terms possible for the entrepreneur. So we do this in 3 ways. The first stage of our service is investor readiness. So helping you build financial models, investment plans, pitch decks, diligence room, and everything you need to put yourself in the best light in front of investors. Next, we introduce founders to relevant investors, so those with capital to deploy in their sector, with real interest in those companies. And then on the third part of our service, we help on the term sheet advisory. So what do the terms mean and how do you go about negotiating them?
Great, so we're going to start by looking at the data. So what does the data tell us about fundraising? And I know there's a bunch of you on the call who are both early stage companies and some who are later stage companies. So this looks at data across the UK, and it looks at data of both deal volumes and deal value. And so what you can see is because of the situation that we're facing at the moment, there's been a fall in both the numbers of deals and also the value that's been invested into companies. So 20% fall in value and just over 40% fall in volume. And that's looking at the last 3 months of 2020 and the first 3 months of 2020 and the first 3 months of 2019, because that's the best way of looking actually the relative change because of the fact that much of the venture industry in the UK is cyclical due to the tax efficient schemes across EIS and VCT funds. And then specifically looking at April data, so April data for this year and April data for last year, you can see there's been a big drop from 800 deals to 400 deals. So clearly, it's not a surprise that fundraising activity has fallen, but there are still a lot of investors that are engaged in investing in activities, and we're going to talk you through some of those options just now. So broadly, the fundraising landscape can be split up into 7 buckets. And these are the ones on your screen now. You've got the venture capital funds, you've got the EIS and VCT funds, the CVCs, family offices and angels, government support, and also venture debt. So I'm going to talk a bit more about how to tell whether a VC is active and an EIS firm is active in just a second, but touching broadly on first CVCs. So corporate venture capital typically is 10 to 20% of the total funding across Europe. It's likely that in the current climate, that activity will fall significantly. And this is because much of the procurement process for large organizations, typically, especially the investment decisions, might take 6 to 9 to 12 months. And so it's likely that this will extend further, and that process will be longer, because corporates have got a lot of other things on their minds at the moment, most notably sorting out their own backyard rather than looking at which companies to invest. You saw that some CVCs had shut down post-COVID, and others are simply taking a pause. So if you're looking for funding, CVCs is probably not the right answer for short-term immediate cash. When it comes to family offices and high net worths, those are, I guess it depends. Depends whether the family office is first generation, second generation, third generation, i.e. if they're first generation, it's likely that they have been built up by an entrepreneur who, you know, him or her have already exited a business and therefore given back to the community, and therefore more likely to continue investing. But maybe your second and third generations are more the asset allocators, whereby it's the children or the grandchildren of the family who may not be as interested in investing in companies. That's one thing to consider. And then the second factor to consider is how much investing they've done currently. So how big is their portfolio company, and are they worried, and are they required to be supporting their own portfolio companies? Angel syndicates, very similar. It probably follows much of the same factors of individuals. It depends. Some individuals are looking to continue investing, some aren't. And then the syndicate element typically is where you group your angels together, and actually those organizations and that organization specifically invest in companies. And so again, that mirrors much of the risk appetite of individuals. There's been loads of government support. So you'll see that last week, last week or the week before, the Future Fund was launched. So the Future Fund, in summary, is a way for an investor to submit an application on behalf of startups and match the funding, therefore, that is met by the private investors. So there's a bunch of criteria. You know, you need to be UK based or UK topco. You need to have raised 250,000. It doesn't qualify for EIS and VCT schemes, but otherwise, it's a fantastic opportunity for the government to step in and support those early stage companies raising funding. But again, it's not for everyone. And then venture debt. So those of you who've tried to get venture debt will know that that is reserved typically for later stage companies. You need to be cash positive. So you need to be growing, sure, bringing revenue in, but actually your net cash balance needs to be positive, i.e. you need to be able to afford to pay the interest that they charge. And typically venture debt comes in alongside an equity fund provider. And so it's rare to find a venture debt provider coming in with $500,000, 1 million, when you don't have institutional investment already. EIS and VCT funds, which arguably dominate the early stage venture scene in the UK, and it's probably one of the reasons why London is where it is and the UK is where it is, because of this generous scheme and offer by the government. What we've seen there is that typically those organisations invest more during the end of March because of tax year, because of the benefits on the income tax liability of many of the investors in those organisations. And therefore, the impact in the short term is there, but the bigger impact is clearly at the end of the year. So we'd advise, before engaging with those kind of organisations, to really understand whether they've got cash to deploy. So some of them have just announced, say, a fund. So for example, Pretoria Ventures, one of the VCTs up in the north, have just announced a fund a couple of weeks ago, whilst others are not as active. And you can understand, right? Because if I'm a VCT or an EIS investor and I have a portfolio who requires my attention, I'm much more likely to be supporting those companies than looking to source new deals. So that's a kind of quick overview of the different options available to you. If you're very early, angel syndicates, family offices, and EIS and government support is more likely to be relevant. If you're a bit later stage, some of the mid and top tier VCs, venture debt, and some form of government support is available. So there's been a lot of discussion on LinkedIn, or discussion online. I'm sure you'll have seen a lot of investors who say they're open for business. So what does that mean? We find that means that they're open to be receiving pitch decks, they're open to take Zoom calls, they're open to have initial conversations with companies, but it doesn't always mean they're open to invest capital. So we've put a couple of factors on screens, I think, to think about when looking to engage VC. So, for example, has the investor recently raised their own fund? Do they have capital to deploy? VCs fundraise themselves, and it often takes them 2 to 3 years to raise capital. It's even harder for them than it is for entrepreneurs. And so the ones who have raised fresh capital are available and have money to deploy. And it's probably worthwhile looking at the last 12 to 18 months of funds that have raised capital, because typically it's a 2 to 3 year deployment. It's a 2 to 3 year process to deploy capital. The second one is, has the fund made investments recently? So have they, in the last 4 to 8 weeks, invested in early stage companies in the similar sector to you or in a similar size? So that is the best way of seeing if a fund is truly open for business, because the data doesn't lie. And even if the fund has spoken and been in discussions prior to COVID with that individual company, and we've worked with a bunch of companies where this was the case, and they closed over the last month or so, actually it still indicates they're open, because they might have had other discussions on valuation, they might have had to discuss terms, but actually the fact that they're still investing is a good signal. The third factor is to consider the impact on their portfolio. So companies in the leisure sector, companies with a bunch of portfolio companies, maybe in the luxury sector, maybe in transport, those organizations will probably be more heavily incentivized to focus on their portfolio companies. And that makes a lot of sense, because you've got to think about it from an investor's point of view. If they have portfolio companies in need, they absolutely need to support those organizations. So how many of those portfolio companies are in need versus those who've got fresh investment, i.e. they don't have any portfolio companies yet to support, or those organizations where they have a focus on some of the sectors that are doing well, ed tech, health tech, some B2B organizations, etc. How far is the fund through its deployment cycle? So, for example, is the fund in its third or fourth year, and therefore is it focusing more on follow-on investments, or is it in its early years, which links a little bit to whether it's raised its own fund. And then lastly, how impacted are its limited partners? So its limited partners in a VC are the investors in the fund, which may be corporates, endowment funds, it might be family offices. And although you might not see that information, it's interesting to actually, when you're speaking to them, ask them about it. So imagine a hotel chain. A whole bunch of VCs have got a hotel chain as their investors. It's unlikely that hotel chain may be able to meet all of its commitments, because as entrepreneurs, when you ask for money from a VC, that VC is unlikely to be simply sitting on their £50 million fund in cash. What's more likely is they need to draw down that money from its own investors. And if its own investors are being impacted by COVID, clearly that investor is going to struggle. So we've published a list on our website, which you can access if you just Google Mountside Ventures. There's our resource section, and we've published a list of VCs that raised fresh capital in the last 9 months, and also those who have recently invested in the UK. So we're trying to be as helpful as possible, and I think there's around 150 or so VCs that have recently raised, and 30 or so funds that have invested capital in UK startups recently. The last thing I'm going to talk about is valuations before handing on to John, who will give you some tips on what to think about before and after your pitch. So there's been a lot of discussion on valuation, what the impact has been. Overall, the consensus for investors is simply to follow the public market. So there's been a 30% or so drop in the FTSE, 30% drop in the US market. It's likely that the logical investor would follow the public market, and therefore we'd expect a drop in valuation of 30 to 40%. This is refreshing for some investors who thought that the valuations were high for many early stage companies. Of course, we're not going to find many entrepreneurs who believe that the valuations are high. The imbalance between entrepreneurs wanting as high valuation as possible and investors wanting as low valuation possible is going to remain. But there is an expectation in the market that before COVID, those valuations were a little high, and so there's been it's been refreshing for many investors to see some of those fall. Typically, revenue multiples for B2B companies, we've seen 3 to 8 times. Now 2 to 5 times revenue is more common. And remember, you can argue if you're fast-growing companies, and there's many ways of discussing about your valuations, and I won't go into all of them now, but remember, you can argue if you're growing quickly to use your forward-looking numbers rather than your historic numbers, if you can back those up with a solid pipeline and committed contracts. Anecdotally, one of the areas that we've mentioned, actually, conversations with investors suggest that they're not really seeing this drop in valuations. Instead, they're seeing companies pivot. They're seeing companies talk about their pipeline with confidence, which is great, as you guys should be. But actually, anecdotally, this isn't really coming in. And so we'll have to wait and see what the data shows as to the true impact of valuation changes. And then the final point to think about on valuations is, again, you've got to put yourself in their shoes. An investor is going to be valuing their own portfolio. And the way they value their own portfolio typically is using the fair value approach, which isn't just looking at the last round, it's looking at what they believe they can sell their portfolio right now. And so they're taking a more conservative view on their own investment to their own investors. And therefore, that's something to think about when you're pitching to them your business, because ultimately, an institution, when they're making investment decisions, it's not a decision they make themselves. Much like your family offices and your angels, they can look in the eye and go, yeah, this business is great, I'm going to invest. With an institution, they've got a duty to their own investors. So this could be, EIS funds' duty to their retail investors, to their individuals, or it could be a VC's duty to their own LPs. And therefore, when you're pitching to them, when you're discussing with them, especially on valuations, just think about that. Think about the fact that they've got their own bosses to report to. And so the clearer you can be and the more data you can provide to them, the more likely you are to be able to be passed up the chain through IC and through to term sheet stage. I'll hand over to John now to talk a bit about how to engage with investors remotely.
Hey, thanks. So with pitching remotely, there's only one objective in mind, which is how do I build trust with an investor quickly? And how do I portray the credibility of myself to be able to execute the investment plan that I've presented to the investor? So Jonathan gave a load of tips on how to research the investors before you meet. And this is important because if you aren't meeting relevant investors, you're essentially burning your own time, time that you can spend with your employees, with your clients, and building your business rather than trying to become a professional fundraiser. On that, some anecdotal evidence is some investors are looking to drop their check sizes to support companies to reach the metrics needed to raise their larger Series A or chunkier round. And so over the next couple of slides, I'll give you a few tips on, I guess, how to build credibility and how to advance yourself along the VC's pipeline. So main thing, and I do appreciate the irony of giving this webinar while sitting on my sofa, but ensure to circulate your materials in advance. This is important because going through a pitch via a remote webcam, it gives you very little opportunity to interject and ask questions and evaluate the opportunity in front of you. And so this will give them a chance to kind of zone in on what your business does and the key areas of focus that they want to identify and push their questions towards. Join early, test your connections and audio visual. Sounds obvious, but obviously everyone's very time pressured with back-to-back meetings. So just carve out that 5 minutes to test it. anecdotally, again, it is shown that if you drop out halfway through a meeting, it can affect your credibility. And remember, the entire point of this exercise is to build credibility. Jonathan touched about it earlier with the public markets, but be really cognizant of what's happening. So it might be unfair to say that tech companies are hit as hard as some public companies because of the nature of their remote product. But there's multiple things that you should be doing in terms of scenario analysis to mitigate what the investor thinks about your business. So if your financial model and your investment plan is the same now as it was back in February or January, then you're probably missing a few tricks. And if you haven't addressed the downfalls of COVID for your business, then that's going to knock your credibility. And if there is no effect, then you want to prove that, because you want to make everything factual based rather than opinion based. Kind of sentiment in the market now is previously you want to have about 12 to 18 months of capitalization. And I think this is now more like 18 to 24 months in the current environment, which means that kind of flexing your revenue and expense assumptions is really important. So what happens if you're not able to upsell ARR with clients? What if you have to offer higher discounting? What if you get rid of your office and you don't have enough expenses? What happens if you pay, I guess, your employees less or take a pay cut yourself? So these are all the things to think about before the pitch. And now we'll move on to during the pitch. Cool. So the main thing, and one thing that we did during this webinar, is introduce yourself. So venture capital investment, at least at the seed and Series A stage, is very much about the human connection. So does the investor have confidence in you as a person? And then that leads to, do they have confidence that you can deliver your investment plan? Building relationships is much harder over video chat. I myself much prefer face-to-face interactions, but I think it's got to the point now where everyone has to adapt, and it's something that everyone needs to start getting pretty good at. So before you jump into everything, and before you suddenly jump into your pitch and start talking about your product and your business, set expectations and a loose agenda. So what you don't want to do is spend the whole session talking about yourself, not building any human connection, and not understanding the investor's interest and what they want to get out of the meeting as well. Something like, great, let's introduce ourselves, have a little chit chat, and then I'll jump into my pitch, and then we'll leave 5 to 10 minutes for Q&A at the end. Super loose, but it's good to set expectations in the general format. And yeah, as I said, ensure the meeting is two-way. So you're selling your business to an investor, but it's an investor's job to deploy capital. So they should also be selling their fund and themselves to you. And you can do this just by expressing interest in stuff like their LPs, their portfolio companies, previous exits, how they've usually interacted with a board on a previous deal, the value they've kind of added, corporate introductions. These are all the things you want to tease out of them to understand if they are the right investor for you. And you want to mute distractions. So if your family are watching Netflix, if you've got a plumber coming around, then make sure you've organized those for the right times. Because as I said previously, you don't want to knock your credibility when you don't need to. And then, yeah, end your pitch with a clear ask. So we're looking for the right investment partner who understands the market opportunity and would like to join us on the journey. And if there's any questions that were asked in the Q&A that you weren't able to answer, address them. So you say in the follow-up, hi, these are your points. I'll get back to you in the next couple of days, or preferably within 24 hours to keep up that credibility and show that you really have a good grip on your business. And ask for more questions. There's no harm in having more questions, because the more questions you're being asked, the more interested they are in your proposition. So yeah, end your pitch with very clear ask and follow up immediately with next steps. So what do you do after your pitch? As I said, follow up with agreed next steps. And one thing that not many people do, which is good to do. Again, it builds your credibility. Add the attendees on social media, drop them a quick note, say thank you, looking forward to the next time we catch up. And but on the flip side, make sure that your LinkedIn is updated. So again, comes back to credibility. And if you can show that you're proactive and following up, you've got a good pedigree, you've got good experience behind you, they're all brownie points that you start collecting to advance yourself to the investment committee with the investor. And the main thing is debrief and reflect. So the initial pitch you do will never be the perfect pitch. So every meeting that you have, you should be reflecting on what went well, what went badly, what were the areas of focus and the questioning. If it's kind of a much wider meeting, if it's a later stage investment committee with 2 or 3 people on a video chat, it might be worth having a spotter, someone who is able to join, engage reactions at certain points, and then they can debrief with you and understand, where do I need to, I guess, be more enthusiastic, spark more interest, where did they seem a bit bored and I can skip over quite easily. And so with that, yeah, follow up, ask lots of questions, and be very prompt in answering questions that you asked. Cool. And we've left some time at the end, some Q&A. So if that's around how to research a fund, who's actively investing, or maybe some thoughts on your pitching technique and remote pitching. So I'd like to open the floor up to any questions for myself and Jonathan.
Thanks a lot, Jonathan. That was a really insightful session. I do have a question from Michelle Gomez, who's asking that if companies aren't ready to start fundraising, should they start building relationships with potential investors now? And if so, how do you start building that relationship?
Shall I take this one? Yep. I guess it depends on your bandwidth. So if you're super early stage and you know that you're unlikely to get investment for the plus 12 months from now, you need to evaluate your own time. So is my time better spent on my products and with my team and commercialization, or is it better spent warming up investors for later on? And one thing to avoid at the really early stage is, if you are approaching these VCs at the early stage, they will be adding you to their CRM with notes alongside that. So if you present a plan that isn't kind of airtight, isn't what you might be thinking about pivoting in 3 to 6 months, have all of those things in mind, because then if you go back at 12 months later, your original plan would be in their CRM, and that would be kind of the initial point of your relationship. So yes, always it's good to build investor relations, because it's hard to build trust and relationships in a very short period of time. So the longer period of time you have, the more trust and credibility that you can have. But spending time on commercialization in your business is the core part of your business. Investment is just a supercharger for the appropriate time. I hope that helped.
Yeah, and I guess there are a lot of pitching events that are delivered now online. So that's another way. And I heard that investors are really looking into that as well. So they can't attend any offline events as they used to, but they're definitely keeping an eye on new opportunities through pitching events delivered online now. There is another question, and the person is asking, what can founders do to evaluate valuations? And is there any information to compare sector benchmarks on what a valuation might be?
Yes, so in terms of benchmarks, there are a number of tools that you can use. So Bowhurst in the UK is one of the providers that has a good amount of data on both startups and scale-ups. So they try to have all the information, public and not public where possible, of fast-growing companies. And they've released a tool recently where you can look at benchmarks based on bigger companies as well, so corporates, when they were startups. So you can choose a sector, and you can choose a size, and you can see the kind of revenue multiples that were obtained for the different funding options. So that's one option. The Bowhurst reports as well are free, but in order to access the data, you need to pay. There's also a number of other startups that publish information, which if you drop us an email, we can point you towards. In terms of methodology for valuations, very briefly, the kind of 5 approaches are your replacement cost approach, which simply looks at the amount of resources and time that you've put into the business, and that is effectively your minimum, your base valuation. So you look at your number of employees and you look at the number of years you've been in, you say, you know, we've had 5 employees at £100,000 a year for 3 years, this is our valuation at an absolute minimum level. The second area is looking at your multiples. So applying a simple multiple to your forward-looking or backward-looking revenue. The second one is a valuation method that looks at that is how companies such as Google and some of the other big tech giants value early stage companies. The kind of acqui-hire approach, where you simply value a business based on the number of deep tech or number of individuals in a company, typically roughly $500,000 to $1 million per individual. The fourth method is looking at a DCF, so discounted cash flow method. This is not as used as widely in the venture scene, but typically what you do there is that you look at all your costs, you look at all the revenue for an infinite period of time, discounted at a discount rate, and that is your valuation, i.e. what is your profit over 10, 20 years, and therefore what is your valuation now. And then the last method is the kind of the simple VC method, which simply looks at how much you're looking to raise now, how much of the business you're willing to give up, and it's a simple maths that takes into account your expected return in the future. So if I'm a VC and I've got a £50 million fund and I'm investing, let's say, 10 million into a company, probably more than maybe a £50 million fund, but bear with me, I'm investing 10 million into a company. I would want that company to at least bring back double or triple my fund. Therefore, I'm looking at least 10 to 15 times return. Therefore, if you're valued at a certain amount, you need to show that you've got the ability to grow 10 to 15 times. And if your model only shows that you can grow maybe 5 to 10 times, therefore, as a VC, I need to take a bigger chunk of your business in order to compensate for that growth. And so the method effectively looks at the amount of return I need to get in the future as a VC in 5 years, and works out the amount of equity I need in a business like yours in order to satisfy that return profile in the future.
Thank you, Jonathan. That is a very thorough response, and I think that's very useful. I do want to thank you for your time this morning and for delivering such an insightful session. So thank you, Jonathan, and thank you to the audience. I do hope you found it useful. Want to bring to your attention that this particular session is part of Navigating the Crisis series, which we've started at the end of March, and we do have a few more sessions which are of interest to early stage entrepreneurs, and you can find those on Funding London's YouTube channel. And with this being said, I do want to wish you all a wonderful rest of today and hope to see you on the 16th. Thank you again, Jonathan, and thank you to the audience.